Just read The Big Short or watch the film. The film is actually pretty good. I read the book before I saw the film. I thought the film was pretty comprehensive. They changed a couple of the names of the characters, and they changed a couple of the circumstances of their families, but it's unrelated to like the point of the film, right? In the 70s, the bond market really took off, right? The main culprit for the housing crisis was something called an MBS, a mortgage backed security. What they do is they take a bunch of mortgages, and these were invented in the 70s by a guy named Louis Ranieri, I think is his name. They took a bunch of mortgages, bundled them together, and turned them into a bond because they figured, hey, no one's going to not pay their mortgage, right? Because in the 70s, mortgages were much harder to come by, and they were much more secure than they are now. They didn't have those like variable interest rates and all the weird things that the mortgage companies started doing in the 90s and 2000s. So they sold those bonds and created something called a CDO, a collateralized debt obligation. So originally, all the mortgages in these bonds were guaranteed by the government, very secure. So the bond was AAA rated. That's like the highest rating, right? But then over time, and especially in the late 90s and early 2000s, they're not insured by the government. They're much riskier. So they should have been rated lower, but instead, the rating agencies, who are publicly traded companies, kept giving these bonds the same high ratings, even though they were much less secure than they used to be. So there's like, I don't know, like thousands of mortgages in like various like tranches, like groups, right? That are bundled up in these bonds. And there were always some riskier mortgages in these bonds, but it was a very, very small portion of them. And then it got to the point where a huge portion of these bonds were made of very risky mortgages. So it got to the point where if more than a certain percentage of the mortgages in those bonds failed, the entire bond was worthless, right? And in like 2005, 2006, about 3 or 4% of those mortgages in each bond were failing. And somebody estimated, like a handful of people really, that if the default rates went above 7%, that's when the entire bond would fail. But most people on Wall Street still thought that these bonds were worth something. So they bet on them, going up in value. But there were a handful of people that knew that they either were already worthless or would be worthless in a couple of years, and they decided to short them. Now, the people that shorted the bonds didn't cause the housing crisis. They just saw an opportunity to make a lot of money on something that was going to happen anyway, that the rest of Wall Street was not aware of. Okay, now back to CDOs, collateralized debt obligations. Some of the banks knew that these bonds weren't worth shit, right? But instead of just not selling them anymore and being like, no, we're not going to sell these bonds, they did something else. They took a bunch of shitty bonds, bundled them all together, and created something new. That's a CDO. But again, let me remind you, the rating agencies were still saying these bonds were valuable. So they were rating them really high, saying that, oh, the mortgages are totally good and they're just like the old bonds we've been selling the whole time, right? Now, the great thing about the film, The Big Short, is that when they get to these very complicated financial terms, they always cut to some famous person to explain it to you in a very basic way. Among those celebrities that they got for this film were Anthony Bourdain, may he rest in peace, and Margot Robbie and Selena Gomez. So when you get to the point where the financial terms seem super complicated, boom, they cut to a famous glamorous person, and then they give you an analogy and it'll totally make sense. So meanwhile, they're packaging all this non-valuable crap and calling it valuable. No one is aware that it's not valuable. So all the big banks, like the bank that you might have a checking or savings account at, and they take your money and they invest in things. So you're basically, deposits are like loaning your bank money to invest in things, right? So all these banks, all the big banks, were invested in these bonds thinking they were valuable. So when you hear the term subprime mortgages, that means these shitty, risky, variable interest rate mortgages that have a high chance of going into default. That's what that means. Now, the guys who knew that these investments were not valuable, and by the way, it was actually a woman that predicted this, who worked, I think, for Citibank at the time. I don't know if she still works there. And her mentor was one of the guys featured in the book and the film, the guy that Steve Carell plays. That was her mentor, and she was actually the first one to sound the alarm. That's just a side note. So the people who knew these bonds were shit, right? They decided we're going to make money off of these. So they bought something called a credit default swap, which is basically an insurance contract on the shitty mortgage bonds, right? And these credit default swaps will compensate the buyer, the holder of that credit default swap, if there's a default. That's why it's called a credit default swap, right? So if the bond fails, you get paid. Now, you can make more money the riskier the bond is that you're getting the credit default swap on. But a lot of times, since no one else was alerted to this kind of small group of investors was able to get these credit default swaps really cheap, because to the outside eye, they were betting on a AAA rated bond to fail. So the credit default swaps were cheap, right? But these investors knew that they were destined to fail and that it would only take a couple of years. And what made it really blow up is that there were things called synthetic CDOs. So if a CDO was banking on the idea that the bond was going to get more valuable or less valuable, the synthetic CDOs were investments that were like betting on the outcome of the first investment, and then betting on the outcome of the bet of the first investment, and like on and on and on. And they created a bunch of these things out of thin air, which is why when people talk about, like Wall Street lost us all this money, well, they did, but really the money never existed. The money was created out of thin air, but all of our mortgages, our savings, our 401ks were invested in these companies, and our funds were held at these banks that were invested in all these things. So when the bottom fell out and all these investments were worthless, so were our 401ks, and so were the value of our homes, et cetera, mass layoffs, homelessness, boom, the housing crisis. Now, I am not an investment expert. I just explained that the best I could based on what I remembered from reading the book and watching the film and interviews of the actual people I watched on YouTube in the years after. But that is basically what happened. By the way, mortgage-backed bonds are not new. The very first bond market in the United States was also backed by mortgages, except those mortgages were not on homes. Those mortgages were on people. Comment if you want to hear about that.